In this video, I want to look at Lemonade's Q4 and then also their 2026. So Q4 and 2026, what am I expecting for Lemonade? We're going to dive into some of the numbers here, show you a few graphs of why this is such a pivotal point in Lemonade's history and why I feel like it's just such a critical time for the stock and for the company. And I've talked about 2026 and 20 and Q4, the end of this this quarter before, but this is a video that's been just updating all the numbers and details since we've had Q3, which I haven't yet talked about here. So we're gonna dive into those numbers. If you want to join my Patreon, there's a number of spots remaining. You get access to this model for $5 a month, and I'll be continuing to improve it and roll out other content as well. So feel free to join that. There's over 200 people now joined my Patreon. It's just absolutely wild for how tiny my account really is. So super humbled and grateful for that. Glad people are finding value in all of this. And also, I want to give a shout out if you're watching this. Please check out Domien's video. He did this 3 months ago on his YouTube channel. I'm going to link it down below in the description. He said, "When will Lemonade be adjusted EBITDA profitable?" And in that video, he, by the way, he's super brilliant, super smart guy, super high character, nicest guy you could meet, and he breaks down a lot of the commentary that's come in the earnings calls and letters about when profitability might come. He really looks at the detail of that, and then also looks at kind of his own sense of when profitability or adjusted EBITDA profitability will be coming. So check out that video if you want to see that side of things, like what management says. But in this case, I'm going to be looking more specifically at what do I think. So some of the key inputs, the way I've done my model is I have IFP growing at a sort of an assumed rate. So I have accelerating slightly. We're at 30% year over year, in Q3. I have it kind of growing to 31% and then even going up to 32% growth by the end of 2026. So that's sort of my assumed growth. And then I work backwards from my assumed growth to say, what am I spending on marketing and growth spend to get me there, based on what the sort of efficiency conversion of that marketing would be. So if we scroll down here, one of the big inputs is the gross loss ratio, or your loss ratio. So I'm suggesting, hey, in Q3 they had 62%, and I pointed this out on X on Twitter, that if you look at ex-cat, they were at 56% in Q3. If you look at ex-cat for Q4 of 2024, a year ago, they're at 62%. And if you look at there doesn't seem to be much cat that's happened so far in Q4. In fact, on the earnings call, Daniel said, barring no catastrophes, so far Q4 is on track to beat Q3, which is 62% and 56% ex-cat gross loss ratio. So it wouldn't be, I have 60% in there for Q4. I wouldn't be surprised if they even surpass that and you got maybe they're like 59, 58%. Would not be surprised at all. But for this exercise, I'm putting 60% in there, for at least for Q4 Q4 of this year. And then next year I have across the board 63%. Obviously some quarters might be higher, some might be 70%, and the other one might be 58%, but as a whole average, I'm saying 63% based on, where we've been trending right now, and then sort of assuming there's maybe a little bit more cat mixed throughout the year. So that's where I'm going on your gross loss ratio. That's one of the biggest updates. I feel like I had this higher, if you go longer term, I have this 64%. I had that, I think, at like 67% in prior modeling, but so that's how I'm sort of modeling that out into the future and for the next year. And I think that was one of the big updates from Q3. The results was just how strong the loss ratio continues to become, and the underlying trend, below it, even ex-cats, even getting better and better. And car loss ratio continues to even come down. If we flip over here and we look at loss ratio By type, cars at 76%, and it's falling down. So as car can ramp up now and have better and better loss ratios, your overall loss ratio can stay, very, very strong, I think. So that's what I'm assuming for next year for your loss ratio. And then if you look at churn, customer churn, historically it's been like 16 some percent. I have it at 16.5%. They don't actually release this. This is a number I calculate based on annual dollar retention. And if you look at annual dollar retention, I'm kind of like just a little bit better. We were at 85% last quarter. It's sneaking up back into the high 80s, which is where we were. We were at 88% back in, at sort of the high water mark. And annual dollar retention will benefit if cars rolled out and sort of ramping up, you will have an increase in annual dollar retention just because those cohorts, you'll have the cross-selling of customers up to car, and that pushes your retention up for those numbers for those cohorts of customers. So then I have here, this is a key number in my model, is how much you're spending on gross spend and then how much IFP or in-force premium you're acquiring. And this accounts for the premium that's also churning away. There's if you think about like a black box of at any given quarter, so maybe we ended the quarter of 1.1 billion, between Q3 and Q4, that black box, there's a certain amount that's leaving, churning away, but then a certain amount that's coming in the door. And that eventually I'm saying, hey, we're going to get to 1.233 billion maybe in Q4. But it's all, this number is all just based on the dollars that are coming in the door, not worrying about the dollars that are leaving, which you are accounting for, but it's only looking at, hey, what are we getting, what's coming in the door for every dollar we spend on gross spend. So you can see it's like if in Q3, I'm saying it's about if they spend $1 on gross spend, they got about $2.56 back. Or came in premiums. And you can see it's 2.37, 2.74. It's a little bit of a function of, how much they're spending on their gross spend line. So I had 46 million. So if you spend more and more, this number is going to get reduced. If you spent, 500 million on gross spend, you'd have a really low ratio because a lot of those dollars would just be completely wasted, would have no return for them. They'd spend and get nothing back. But they've been at a pretty healthy rate in the 2 point, something, and I continue to think they'll be sort of in the 2.5 and higher. I think is a pretty decent chance. So I have modeled out 2.65 as an overall average, and then 2.56. I just copied what was in Q3, and then a little bit higher next year as I'm assuming cars in even more places, and you're getting more cross-sell on car, and you're really identifying the excellent car customers and cross-selling them well. So, but if you look at gross spend as a whole, I had 180 million, 179 through this year. And then next year I have, some of next year, 206 million. You can see a graph of that. So this is quarter by quarter, but you can see this previous, year, and then I'm projecting out Q4. So here's this year, current year right here. And then next year, I'm just projecting that, hey, we're going to just slowly accelerate up as we're spending a bit more each quarter to maintain a higher amount of churn. And that's going to, push us up into, spending over 200 million next year. But as you can see, you don't have to spend, actually, you're growing 30% more, but you don't have to spend that much more based on where your churn rates are at, based on where your annual dollar retention at versus, say, where it was the previous year. But based on, that's where I have those at 2.65, 2.56, and it's a nice visual of kind of where that's going to go. And of course, that's going to keep growing. That's just going to go higher and higher. But if unit economics makes sense and your products make sense, and they're big enough, massive product lines that they're just starting to dip their toes into, I think there's massive room to continue growing at a healthy rate for a very long time and really grow into those product lines. So that's where I have all that. I still have synthetic agents being used. I have, other insurance expense growing 2% a year, tech development growing, or 2%, quarter over quarter. So some tech development even within there. That even sounds maybe a little bit high, to be honest. 2%, 2%, 2%. Then, G&A, general administrative, I have part of that is the interest you're spending on the debt from your synthetic agents, and some is like what I'm calling your G&A core. That I have is fixed, and then your debt is growing a little bit as your amount of synthetic agents is growing. And you can think about it as all of your operating expenses minus your growth spend. So everything without the growth spend, you can see was 95 million in Q3, and I have it growing up to 101 million. And that's about, 5% year over year growth. So some modest growth, which I think is sort of roughly what we'll see, in the longer span of things, but climbing up there. So what does this get? What does this get you? What are the results of all of this? Well, from an adjusted EBITDA basis, it gets me minus 11 million in Q4, and then next year it gets me to drumroll please. We have minus 1.9 million, so super close to break even. I have like a minus 10, minus 11. You have very similar Q1 to Q4, and then Q2 you're maybe just slightly negative. Q3 I have as the first positive quarter, and then Q4 as even more positive quarter. And we can show this. I have an adjusted EBITDA graph here. So again, gray bars are projections. Going into Q4, I have you can see it actually sort of follows a trend line from where this low point here, or even you could back it up all the way to here. There's obviously been some lumpiness. It depends on the loss ratio per quarter, and these probably might have a little more variance. But you've been on a trend line where they actually told us this was going to be peak losses, and they've had a slow turnaround as their investments continue to pay off. And I think we'll continue that trend line right up into the future. So, and then of course, if you look at adjusted EBITDA on a forward-looking basis, we're like zoomed way out now all the way to 2035. I think something like this might occur where we've had this negative territory. We're making tons of investments into the business, building the products, growing out customer bases. And then we're going to start flipping to positive, and then it's just going to become pretty obvious pretty quickly that they're going to be massively profitable. And even still, like, we might grow to $300 a share, and it might be 2029 or something, and it might be still super undervalued. It might be like, man, we can buy shares at $300 a share still, and people don't realize like it's going to hit $1,000 a share before people realize, so because it's going to keep growing and scaling. So it'd be interesting to see how the story, sort of the mix of how bullish the market is on it, and or how sort of misunderstood it continues to be, even after they're profitable. But I really don't know what's going to happen. Anything can happen. The market could start to understand the story better, and they could go absolutely euphoric, crazy, and anything could happen. I could see $300, $500 a share in a not very distant future. Maybe by the end of 2027, we're at $500 a share. Not financial advice, but I think it's going to become clear that these green bars are going to be boom, 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 like accelerating profits. Because look, if you go here, I'm basically break even on adjusted EBITDA, and then I haven't modeled these as closely since then, but I have just for what the numbers I have right now, which will be decently close, is 76 million, 28. I have, 200. So you're like tripling your profit for some of these years, 200 million, then 317. So over 50% growth. So your profit's going to grow much faster than your top line, because you have this huge base of more fixed expenses that you're springboarding off of that continue to stay fairly steady, but then your profits are tiny, and then boom, your profits explode. And once the market realizes, that's what's going to happen, then things will get crazy for Lemonade. So, and that could happen as soon as February. It's already more and more of the market, it is already in a way happening, because, if you look at X members of our group, this is Lemonade community members on X that I've been tracking. It's we'll probably hit, 5,000 members before the end of this calendar year. And I think that's just going to continue to accelerate, up. So, yeah, it's it's going to be crazy times. That's my prediction. It's crazy times. We're on the edge of crazy times just starting to happen, and it's going to get crazier. And so it's exciting. But yeah, that's where I'm seeing. I think we're going to have probably like, close to break even. That's what I'm predicting. I don't think guidance will be this good. I don't think they'll guide for minus 2 million EBITDA, loss in 2026 when they put out their guidance. I think it's more likely they'll say like, I don't know, minus 15 or something. And then by the time, as every quarter, like they typically do, they outperform, and then the guidance, improves. And by the end, they'll be like, oh, actually, yeah, we pretty much did nearly break even, or something close to it. And maybe even breaking, I might even be wrong. Maybe there's a metrics here even a little bit higher, or maybe they don't they don't even grow quite as fast. They grow I have 32% growth. Maybe they do 30% growth, and they have, the funny thing is, if they grew slightly less, they would, if you had the same marketing efficiency metrics, then their growth spend is going to actually come down slightly, and then their profitability would actually be higher. So your adjusted EBITDA will look better. So it's kind of a win-win, but I think it's, I think there's a good chance their growth rates will kind of come into the low 30s. They've hinted at that in the past in some of their communications, that it could be kind of in the low 30s range. So that's sort of what I'm predicting, expecting on that. And other thing you can think about is like a big factor here unknown is, what does this marketing efficiency come in at, right? So if this is a little bit lower, like say this is not 2.65 but 2.5, let's just back up. So I had adjusted EBITDA of minus 1.9, right? So now let's just say they spend a little bit more on marketing for every dollar they want to grow, or every dollar they bring in. So I'm going to change those to 2.5 and then scroll down and look. Now it's like Q3, you might be like minus 0.1, like instead of, it was I think plus 3 before. And for the whole year, you're minus 14. So I wouldn't be surprised they guide something like this. Maybe it's somewhere between, minus 10 to minus 20 million is your guidance. But I don't know. That's if I had to sort of maybe take a stab at what it might be. But I would not be surprised also if the efficiency comes in a little bit higher, because you're pushing CAGR out faster and more, and that's just such a massive market you're just sort of starting to tap into. So, and this is where I think the market's going to get hit in the face, is because say they come out and they say, yeah, adjusted EBITDA guidance is minus 12 for the whole year, minus 12. And, previous, if you look at guidance, like even for full year 2025, it's minus 130. And you're still seeing, previous, like the start of the year was even worse than this. If we went back to the Q4 of last year, it was, minus 140 million at the worst end and minus 135. And then it's improved now to minus 130, so it's improved by 10 at the worst end, and minus 127 and 8 at the better end. So I would not be surprised at all if again they do that. They're like, yeah, it's going to be minus 15, and then they actually do minus 5 or minus 3 or something like that. And and this is where this number I think will surprise people, because they're used to being like, oh, Lemonade, they just lose like 150 million a year. They're just, even in just adjusted EBITDA losses are like 150 million here. What a joke. What a like absolute garbage company, blah, blah, blah. That's what people are going to say. And then like fast forward just next quarter, this is going to say like minus 15 or minus 12 or something, and they have a history of beating it. Like they might even break even. So that's where it gets really crazy, really fast. And then you see these profitability just like stacking up as the underlying business, basically, as you have incredible operating leverage. Operating leverage is everything. And just to touch on to finish off the video here, I think that does it. And again, if you want to play with this model, just join my Patreon, $5 a month. There's only a number of, I forget, there's like maybe 30 more spots at $5 a month, and then it'll go up to $10 a month. But yeah, you can play with this yourself, but my own thinking on where I have earnings per share going, and for 2032, if you say, 2032, they're going to have a 40x multiple on their earnings. They're going to deserve that because they're still, 2032, I have them at, let's go up the top line, only $7.5 billion of IFP in a giant, massive insurance global world that they're attacking. Why wouldn't you? Honestly, you could be like, the PE is going to be 200, and that puts you at a fair value today of over $700. Because why couldn't you be, if you're $7.5 billion of premiums, like, and the world's only getting bigger, and there's more wealth, and there's more things people want to protect. Why couldn't they grow this to like hundreds of billions of dollars of IFP one day? Because they're not even just like U.S. only. They want to be a global insurance brand. So why couldn't they really deserve like a PE that's just outrageous, because they're still going to keep growing into that, because $7.5 billion is tiny even by the time we get to 2032. That's why the story is so crazy, so huge, so compelling. If you put in 50x, multiple, you're still saying, you're worth 190 today. If you say, maybe they're worth 100 PE, you're 379. If you say something really, you're like, they're only worth 30. It's still $114 worth today. This is with a 12.5% discount rate that I'm using right now. You could adjust that and play with what you think there. There still could argue, hey, they're worth like $114 a share right now. But I think this could be arguably, the market might misunderstand it, and they might say, they might not for longer, might understand the sort of massive upside even beyond. It might still dramatically rise, but still be undervalued, is what I'm trying to say. But you can think about that, and you can play with that. We put in whatever numbers you think there, but I think for a company that's showing, hey, they could have world-class loss adjustment ratios, they could have world-class loss ratios, they have a world-class ability to find the best customers early in their life and then grow with them and through all product lines. They have the ability to scale to countries all over the world. Why wouldn't they have like a PE that's like 100? Like, why wouldn't they have in 2032 even? They're just like, this company in 2032, in that if you put it 100 PE at 2032, you're talking, like it's okay, it's worth north of $500 a share. And if you're but if you're at discount that back 12.5%, you're worth, high 300s right now. You could say it's worth high 300s right now. That's why it's almost like, maybe it doesn't matter if I bought shares at $69 or $65. Sure, you want them as low as you can, but I'm just buying. For my mind, I'm pretty decided. I just got to get as many shares as I possibly can. That's my whole, basically my market strategy right now. Not financial advice. Anything could happen in the market, but for the long term, that's what I'm thinking about. And this is the 2032 numbers. If you think 2035, so 2035, I have them at 14.5 billion of IFP. Also, still, maybe you don't say, they're not 30, but say they're 50, then again, they're worth 370 something right now. If you lower that down to 30, you could say, they're worth more than $200 a share right now. So that's how I'm thinking about it, how I'm playing with it. Again, you can dive in, play with those numbers, make copies of this and play with that yourself. But buckle up. Maybe that's gonna be the title of this video. Buckle up, because I think we're in for some exciting times ahead as Lemonade investors. Exciting next quarter, Q4 next year. So let me know what you think down below in the comments, what you're thinking about for Q4 next year, and of this whole video. Any feedback's always awesome. Thank you so much for watching, and remember, it's in the bag.